Hello and welcome to our channel. In today's video, we're going to be discussing how stagflation will dominate world markets in 2023. But before we get into that, let's define what stagflation is. Stagflation is a term used to describe a situation where an economy experiences both stagnant economic growth and rising prices or inflation. This can be a challenging situation for policymakers to navigate, as traditional economic tools, such as lowering interest rates or increasing government spending, may not be effective in addressing both issues simultaneously. So, why are we talking about the possibility of stagflation in 2023? There are a few reasons why this may be a concern. First, the global economy has been hit hard by the COVID-19 pandemic, which has led to high levels of unemployment and a slowdown in economic activity. As we begin to recover from the pandemic, it's possible that we may see a period of slow economic growth as businesses and individuals adjust to the new normal. At the same time, there are also concerns about rising prices. The COVID-19 pandemic has disrupted global supply chains, leading to shortages of certain goods and resulting in higher prices. Additionally, governments around the world have been pumping large amounts of money into their economies in order to stimulate growth and support individuals and businesses affected by the pandemic. This influx of money can lead to higher levels of inflation if not properly managed. The vast majority of Wall Street investors believe that in 2023, stagflation will continue to be the main threat to the global economy and the stock market. According to a new Bank of America Pulse survey, 92% of fund managers predict high inflation and poor economic growth in the coming year, while 0% are predicting a Goldilocks scenario, in which the economy avoids a recession and inflation slows. Investor sentiment was still negative. In spite of last month's 21-year peak of 6.3%, investors keep cash holdings high at 6.2%. In addition, a global recession is predicted by a total of 77% of participants. The responses suggest that the stock market may have another difficult year after central bank tightening, persistently high inflation, and the Russian war in Ukraine already caused massive destruction worth many trillions of dollars. The survey reveals that investors do not anticipate the Federal Reserve to change course until inflation drops below 4%. Despite the fact that stocks recently increased on expectations, the Federal Reserve would soon pause or slow its rate hikes. As the Fed raises interest rates at the quickest rate in 3 decades to keep up with the escalating inflation, there is an increasing concern on Wall Street that this will lead to an economic slump. So what can we do to prevent stagflation in 2023? There are a few steps that policymakers are already taking. First, it's important to focus on boosting economic growth. This can be achieved through measures such as investing in infrastructure, providing support to small businesses, and promoting job creation. Second, it's crucial to carefully manage monetary policy. Central banks play a key role in regulating the money supply and setting interest rates, and they must be mindful of the risk of inflation when making decisions. Finally, it's important to address supply chain disruptions and other factors that may be contributing to rising prices. This can involve working with businesses to identify and address bottlenecks in the supply chain, as well as taking steps to increase the supply of goods and services. While stagflation can be a difficult situation to navigate, it's important to be proactive and take steps to prevent it from occurring. By boosting economic growth, carefully managing monetary policy, and addressing supply chain issues, we can help to ensure that 2023 is a year of prosperity rather than stagnation and rising prices. This month, officials approved a 4th straight 75 basis point rate rise, bringing the federal funds rate to a range of 3.75 to 4%, which is close to restrictive levels. They also gave no indication that they were about to stop raising rates. A worrying development is that the Fed's rate increases have not yet been able to control inflation. The Consumer Price Index increased 7.7% from the prior year in October, according to government data released this month, approaching a 40-year high. That suggests that the Fed will need to maintain its aggressive approach, increasing the likelihood that it will stifle consumer demand and raise unemployment. Fed Chairman Jerome Powell told reporters earlier this month, "Let me say this. Thinking about pausing at this point is extremely premature. People think of pauses when they hear delays. I believe it is way too soon to discuss stopping our rate increases. Still a long way to go. By compelling businesses to reduce spending, Rising interest rates tend to result in higher rates on consumer and commercial loans, which slows the economy. Gross domestic product, the most comprehensive indicator of the products and services generated in a country, fell by 1.6% in the winter and 0.6% in the spring, signaling that economic growth had already slowed in the first 2 quarters of the year. But over the summer it recovered, with GDP rising by 2.6% on an annualized basis in the 3 months from July to September. According to Steve Hanke, a professor of applied economics at Johns Hopkins University, the US economy will enter a recession next year, but not necessarily as a result of increasing interest rates. He said on CNBC's Street Signs Asia on Monday, "We will have a recession because we've had 5 months of negative M2 growth, money supply growth, and the Fed isn't even looking at it." The broad M2 metric is used by market observers as a predictor of future inflation and the overall money supply. Cash, checking, and savings deposits, and money market securities are all included in M2. Hanke cautioned that the stagnant money supply of recent months is likely to cause an economic slowdown. He predicted that a severe recession would occur in 2023. Hanke predicted that due to the record rise in the US money supply, inflation will continue to be high. He noted that the money supply in the United States had extraordinary increase when COVID started 2 years ago, and noted that historically, sustained inflation has never occurred. That isn't the result of excess growth in the money supply. That is the reason for the current inflation. It is also the reason why, by the way, inflation will continue through 2023 and into 2024. The bottom line is that we're going to have stagflation. Inflation as a result of this surplus that's now entering the system, he continued. Hanke stated, "The issue we have is that Fed Chair Jerome Powell does not even now comprehend what the drivers of inflation are and where." He continued to talk about supply-side problems, but he's failed to inform us that inflation is usually generated by excess growth in the money supply, turning on the printing presses. The Fed's strategy has drawn some criticism from David Rosenberg, president of the Rosenberg Research, but in different ways. He claimed that the Fed is now more than happy to tighten policy excessively in order to reduce inflation swiftly. On Monday, he remarked on CNBC's Squawk Box Asia, "Over-tighten means that if the economy slips into a recession, so be it," adding that Powell has emphasized that this was short-term pain for long-term gain. He said he is a little upset that the Fed is not going to take any chances after being thoroughly embarrassed for calling inflation transitory, but that the Fed is not going to take any chances since it is chasing lagging indicators like the unemployment rate and inflation. According to Rosenberg, Powell essentially stated that the economy would be sacrificed in the near future. "I believe the Fed will need to witness 6 months of significant deflation in the pricing statistics before they call it quits, having been on the wrong side of the call for the past 15 months. What do you think of global markets in 2023? And what's your opinion on stagflation, which has been widely predicted for the upcoming year? Let us know in the comments and be sure to like and subscribe. See you in the next one.